Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area, this time October 2022. The hot topic for today, obviously, is rising mortgage rates. We are officially now in 7% territory. That would have been completely unthinkable just a few months ago when we were in 3.5% territory. If somebody would have said 7%, everybody would have said you're crazy. Of course, this has major implications on the marketplace, both on buyers and also on sellers. And I'm seeing a lot of emotional responses, a lot of knee-jerk type reactions based on these mortgage rates. So if you know anything about me, then the best recipe is always to look at data when you're not sure what to do. So that's what we're going to do today. I also want to take a look at a number of scenarios because we have so much uncertainty in the marketplace. It's really hard to look in the future and make predictions. But we know this can go only down a couple different ways. And so I want to take a look at these scenarios so you have some sort of a sense what to expect in general from the year 2023 that's ahead of us, so you can do some planning. But first, let's take a look what's going on currently in the marketplace so we have a good understanding of that. And with that, we are going to start with what's going on in September. So as always, these are the latest numbers from MLS. And the biggest surprise here is actually inventory. As you might recall, with the market softening since June when rates started to rise, a lot of people expected inventory to go up, and that will eventually cause prices to go down. And we've seen some degree of inventory increase. We went from like 2,000 to almost 4,000. But that development has stopped in September, and this number came back lower than expected because a lot of sellers are withdrawing from the marketplace, and we only had 3,800 units for sale on the market, which is 5.2% less than we had last year around this time. And another surprise here is homes sold. So these are actually transactions closed, and that is down 20%. That is a huge decline. That is, we're not used seeing those numbers. Usually we're looking here at 3%, 2%. So that really shows how the marketplace is contracting and there's fewer transactions completed. Ironically, and this is what makes it so confusing, the competitiveness in the market is not really going away. We still have just 8 days on market median, so that's a very, very fast-paced market. You can see that when you're comparing it with September 2015. As always, I have that here as the benchmark year. So this is still a super fast-paced market. A lot of properties are selling on the first weekend, not with as many offers as we have seen it in spring, but it is still not uncommon that we see more than one offer on the first weekend, and we sometimes have to compete with those other buyers. In terms of pricing, that's not a surprise here at this point. Prices still going very strong. We are up in the Milwaukee area 10.2% compared to last year in September, 292,000 median. So that is down from the peak that we had in June. A little bit, but it's still 10.2%, still double digit ahead from where we were in September last year. And we're going to talk about the typical seasonality just a little bit because it is, in my opinion, super important to understand the seasonality. Prices are going down this time of the year. Every year, it's very normal. It is expected. If you look at the big picture, from 169,000 to 292, that's a 72% increase in home prices in the last 7 years. So that is actually, still quite remarkable in terms of what's going on with pricing. All right, let's take a look at rates. After all, this is what's driving all of this. And I have here, as always, the data from Freddie Mac. You can see in blue 6.92% for a 30-year fixed, and then even the adjustable rate 5-year ARM at 5.8%. But I wanted to bring a little dose of reality in here because as soon as you get a credit score into the mix, I pulled here data from Google. You can just Google mortgage rates. It will give you this information. So at a 700 mortgage rate, you're looking at actually a 7.6% interest rate. That makes buying homes quite a bit more expensive. And this has implications for buyers, of course, especially for those that are coming from a rental situation and now first-time home buyers because they have nothing to sell. People who are selling a property, at least they can take advantage of the equity buildup we've seen in the last years. So they're in a much, much different position. They can bring in a large down payment. And so they're not as affected by the interest rates. But we're also seeing this impacting sellers because we have a lot of sellers that are looking at their decision to, if they trade up from their property where they're currently at, that also means saying goodbye to their 3% or 2.75% interest rate, and not only trading into a more expensive property most likely, but also having to upgrade into a mortgage rate that is a higher interest rate. And that is causing a kind of a lockdown effect on the seller side. That's why we're seeing less inventory in the marketplace, because sellers are really very reluctant to take that step. What can we expect in terms of mortgage rates for next year? So as always, I have here the predictions from Freddie Mac, from Fannie Mae, from the Mortgage Banker Association, and from NAR, the National Association of Realtors. And usually they're pretty well aligned. In this case, we're actually seeing that the NAR is the most pessimistic of all of them. But what unites all four of them as we're going through the 4 quarters of next year, everybody is predicting that rates are going to go down towards the end of the year. So the blended average here is 5.4%, and that is kind of the prediction that all of these guys are expecting. So we will see where we land. As I said, a lot of uncertainty in the market right now. We don't know where inflation is going. CPI just came back last week at 8.2%. So at least it hasn't gotten worse if it didn't get better. So my personal assumption is that we have to live with elevated rate of inflation for the next few years, or at least for the next year. But we will see there's a lot of inflationary pressure there. Fuel prices have come down, so that has helped. I'm sure you've noticed this at the pump. But what has gone up actually in a very large degree is rents. That have gone up this month at a rate we haven't seen it in 40 years, and so the cost of housing has really contributed to the inflation on the other side. So we're sticking around 8.5%, and my assumption is that we're going to be there for a while, and that will impact, of course, the Fed policy, and that in return will impact indirectly then also where mortgage rates are going to be, and that's a little tough to predict at the moment. And you can see this is why these guys are so different in their opinion. Normally they're lined up a little bit better. All right, so here's another big topic that I want to bring up today, because this is a conversation I have with a lot of clients. They are getting so much conflicting data. It's on the one hand, they're hearing the market is weakening, the market is softening, real estate prices are coming down, and on the other hand, they're looking at the Milwaukee market and not understanding how it can still be so competitive. And that is actually really quite a bit of a conundrum. So let me try and make a little bit sense of that for you. And what I've put together here is just a snapshot of 10 relatively random metro areas all across the US. I tried to pick a sample of bigger and smaller, of some coastal metro areas, some of the real high flyers, and some of the Midwest markets. I have Chicago in here, Madison, and taking a snapshot on what's going on in September. And there's a number of metrics that we're looking at here. So the first one I have here is inventory measured in months of supply. As you probably know, if you're following me for a while here on YouTube, 5 or 6 months worth of supply is what we consider a balanced market. That's what we had in 2015. So 1 month of supply, 1 month worth of inventory is a very, very tight market. And we still have in Milwaukee 1 month of inventory. When you look at most of these other markets, they are trending between 2 and 3 months. Las Vegas here over 3, Boston over 3. The only other one that is low here is Cincinnati, Ohio. They're about at 1 month inventory, but everybody else is really building up inventory, which of course doesn't help the sellers and puts pressure on them to lower their prices. So let's talk about this. Here's a list to sold ratio. So in Milwaukee, we still have a 102.1% sold to list ratio. That means on average, buyers are still paying 2.1% over asking price on average. So in the summer, we were at 104, 105, I think almost 106%. So the market in Milwaukee is clearly softening, but we're still over 100%. And if you see that on an average, that means there are still deals out there that are paying 5% to 10% over asking price. It's not as common anymore as it used to be early in spring, but still very competitive. And you can see most of the other markets are falling down here into the 97, 96 range. Phoenix, Arizona, for example. The only one that's holding up here is Madison with 100.7. And this is significant. I've done the math here for you. So the difference between a 102 list to sold ratio and the 96.6 is actually on a $300,000 home is $16,500. So that is not insignificant for a buyer, and that gives buyers in most of these markets quite a bit of room to negotiate. Days on market, not a surprise. A lot of these markets are hitting a month on average now, days on market. And also interesting to see the difference in median prices. So Boston here is the highest with over $800,000 in median price. There's a number of other markets. Austin, Texas has also skyrocketed in the last years. They picked up 39% just in the last year. So there's a lot of markets that have gone up really almost exponentially in a very short amount of time. And they're in a very different situation than we are. We're still here. This is city of Milwaukee, $232,000. So on a national scale, we are one of the lowest or most affordable markets that we have in the US. I've dug a little bit deeper on that and want to share this with you. So here we have a list of metro areas. This is data from First American, and they are looking at these metro areas and said which ones of those are overvalued. So the way to do it is to measure a typical household income versus typical home price, and they put out the delta here. And you can see there's a number of markets they are considering overvalued. And of course, you have all the typical suspects here from California, from San Francisco, LA, San Diego, but also Seattle, Austin, Texas here, Sacramento, New York here as well, Las Vegas, Phoenix, Denver, Colorado. So those are all markets that are well known for being expensive, and measured on the local income level that people have, those are considered overvalued because people are paying in relation to their income more money than they should pay for housing. On the other hand, when you look here, Detroit, Philadelphia, Pittsburgh, a lot of the Midwest markets here are still relatively good, affordable, and Milwaukee is also in here. So be a little bit careful when you hear something about the housing market from the, I don't know, Los Angeles Times, or from a national publication or evening news that are looking at the real estate market on a national level. The markets in the US start to detach from each other, and depending on where they're at, they're starting behaving differently. So it is very conceivable for me that next year we're going to see price reductions on the coasts. Meanwhile, it is still possible that we're going to see prices climb up further in the Midwest, just because our pricing is generally still very low, and we have a lot of mobility in the country with people being able to work remote. So that remains to be seen. Just be careful when you see these headlines in the news that are talking about the US real estate market. There is no such thing as one US market anymore, because you really have to look at it on a local and on a regional level. All right, here's another thing that I think is absolutely important to understand, because a lot of people, I read it in the online forums, I hear it from a lot of real estate investors, and a lot of them are pointing to the fact that real estate prices have been coming down over the last few months to a weakening and a softening in the market. And what I have here is super local data. So this is southeastern Wisconsin. That is just the Milwaukee metro area. It also includes Racine and Kenosha. And you can see in our market, no surprise to you, we have a very, very strong seasonality because of our winter season. So we're peaking every year in spring, summer, usually in June. There's sometimes a little bit of an offset here because we have COVID lockdowns. But usually in June, we're reaching peak pricing every year. And then in the winter, we have usually the lowest prices of the season. So right now, we're in the downward trajectory, but that is seasonally expected. If we would not be there, that would be totally abnormal. So you have to expect in the Milwaukee market that prices are softening in September and October, and they will typically bottom out in December and in January. Now, what's difficult to differentiate, because the market clearly is softening and is weakening, but what's difficult to differentiate right now, when you look at the numbers for September and October, how much of that is typical seasonality and how much of that is the impact of the interest rates and of inflation and of everything else that is going on. That is hard to say, so we don't know what's going to happen here next year, and that picture will get clearer in the next months. But so far, Milwaukee, as you have seen, is holding up pretty good. So here's the big picture, or let's take a look at the big picture, I should say. What can we expect for next year? And I'm starting here with a quote from Dave Ramsey. I'm sure you're familiar with him. And he says, the root issue of what drives housing prices almost always is supply and demand. So you can add to that a little bit, because people get sometimes too much hung up in what's going on in politics, what's going on with inflation. There's a lot of things that are impacting a housing market on a weekly, on a monthly basis. But when you zoom out and you look at the US market more in terms of decades and big picture, that you can see it really comes down to supply and demand. How many people do we have, and how many houses do we have, and how much is the competition for these people to get into those houses? So I want to remind you on 2 slides that you may have seen me present here in a market update a couple of times in the last 2 years. And the first one here is the supply side, that is new construction. So we have a long-standing norm here and a 50-year average of how much we are building typically in any given year in the US. And then after the situation that we had, the mortgage crash in 2008, of course, builders went out of business, builders stopped building and developing, and we really cut down on new construction. So for the last 14 years here, we have been under building, and we have been much slower than we have been traditionally in order to bring new houses on the market. So that is the supply side. And there's really only a few ways how you can add supply to a market, because if somebody is selling a house and buying a house, that is a wash, that doesn't really bring any net gain to the marketplace. You're only gaining additional housing units. Frankly, if houses get vacant because people are getting old and are dying, that is a net gain to the housing market. And then, of course, you have new constructions. But those are the only 2 ways you can gain supply. Everything else is just shuffling around. Now, that's the supply side. And where's the demand coming from? That's coming from a shift in demographics. I'm sure you have heard this before. So the millennials have aged into their prime home buying years. A lot of them are 37, 38, 39 years old now. They're having babies, they're getting married, and they're making the decision it's time to stop renting and buy a house, maybe buy a single family or buy a condo, so that they're making the decision to buy. And usually once a family has made the decision to buy a piece of real estate, very seldomly they're backpedaling that and say, never mind, we keep renting. So they may hit the pause button for a while and delay that decision or delay their housing search, but sooner or later they're going to buy a house. And this is where the demand is coming from. And it's also not helping that the US population generally is getting older, and a lot of people are aging in place. They're remodeling their homes, are not putting them on the market. That is also not helping with our supply situation. And we have a lot of baby boomers that are downsizing. That creates a tough situation also for first-time homebuyers, because now they're competing with boomers that have owned 7 or 8 houses over their lifetime. They're not worried about home inspection issues, and they're usually in a position to make a cash offer. So that's tough competition for first-time homebuyers. But supply and demand on a big picture, if you look at it on a 10-year scale, is really what it comes down to when you look at the marketplace. Now, that begs the question, when is or was the best time to buy a house? And when you're a first-time homebuyer, you're basically looking at rent. And I have a chart here that shows the rent since 1988. And as the old Chinese proverb goes, when is the best time to plant a tree? Well, 20 years ago. The second best time would be today. So that kind of holds also true with when it comes to buying real estate. It's very difficult to time a market, and when you're buying real estate or when you're buying a primary residence, it's usually driven by a life event, because your family is growing, or you're moving to a new city, or you're getting divorced. So those are usually the things that are triggering events, and that is what's driving it. So you can see rents are going up actually quite a bit since 1988, and as I mentioned before, rents are at the moment a big driver with inflation. That is really one of those factors that are driving up the inflation cost, because apartment building owners and property owners are also facing higher cost. Contractors have gotten more expensive, energy has gotten more expensive, interest rates are going up. So they're passing on that cost to the tenants, and this is why rents are going up. And I think in Milwaukee we've seen 5.1 or 5.2% so far this year. And I would not be surprised if we see at least that, if not more, next year, because now it is kind of becoming a thing, even in Milwaukee, that we're looking at annual rent increases. That was not always very commonplace around here. So what does it mean if you buy a house? Let's say you bought a house in 2015. So that means you clearly did not buy the house at the lowest price point possible. But what you did is you locked in your payment in 2015 with whatever interest rate that was. I think we were at around 5 or 6% back then. But the critical thing is that it is locked in for 30 years. So that gives you stability and predictability, because whatever you're paying every month, that is going to stay the same for 30 years. Unless you're refinancing, and in this, if you do that, then you can drop down into a lower interest rate. A lot of people have done that in 2020 and 2021. So they lowered the monthly payment, dropped it down, and then locked it in for another 30 years. So that is really the main thing when you think about buying your first home that you should think about, is you're going from an environment that you cannot control, where you don't know what rents are going to do. Yes, it would be better if you could go back and buy a house in 2015. That would be ideal. But still, it's better to do it now, because at least you have the predictability that your pricing is locked in. And if you're worried that the mortgage rates are too high right now and you think they're going to be lower in the future, you always have the option to refinance and drop your mortgage rates down and then be on a lower rate. But you cannot go back with the pricing. All right, so here's another quote that I have from Mark Fleming. He's the chief economist of First American. These guys put out a lot of really quality research. And he said, when the dust settles, and he means the economic uncertainty, those buyers and sellers who are now on the sideline will jump back into the housing game. Demographic trends support elevated demand in the years to come. So it is a question of when for the housing market and not if. So we have a lot of uncertainty in the market. We don't know what's going to happen with Russia. We don't know what's going to happen with the economy, what the Fed is going to do, what our government is going to do. Energy prices, there are a lot of moving parts, so it's very difficult to predict. Mortgage rates are going to depend largely on what inflation is doing and on the Fed policy that we're going to see come out over the next few months. But because of all that uncertainty, the natural reaction from a lot of people, buyers and sellers alike, is just to hit the pause button and just remain on the sideline and not participate in the market until they have more clarity what they think is going to happen. So the best what we can do right now is actually to look at scenarios, because there's only a couple potential ways how this can go down. It's going to be one of the following versions, because from all factors that are impacting the Milwaukee real estate market, inflation, the economy, unemployment, mortgage rates are very likely to have the single biggest impact in 2023 on the market. So all of these other factors will certainly also contribute and shape the marketplace. But what mortgage rates are going to do next year in spring is going to be the number one factor that's determining the market. And so we have a couple scenarios. The first scenario is that mortgage rates remain rather high, 6 to 8%. This is very likely if the Fed keeps their foot on the brake and keeps following a very restrictive policy. And if we see that, then rates are going to stay rather high, at least for the next few months, and that could mean around 6 to 8%. So what does that mean? Sellers are going to be less inclined to list their home and give up their low rate. So the typical scenario would be somebody has a house in Wauwatosa worth $500,000. They have accumulated $200,000 in equity and they're thinking about buying a bigger house. But because of they are locked in right now in a 3% mortgage rate, and they would be buying from a $500,000 house to a $700,000 house, and now they have to go into a 7% mortgage rate, that makes them very reluctant, and they're not very likely to make that move right now and put the house on the market. So that means they are withdrawing inventory from the market, and that's inventory that we would need. So spring inventory will likely remain lower than usual, and the market will remain moderately competitive. I would expect a version of what we're seeing right now, not the crazy spring market that we see with 10 competing offers on one property or even more, but something like, going quickly for full asking price, or even having 2 or 3 competing offers. That would be kind of that scenario. The other possibility is that we are seeing mortgage rates to drop in spring. So if the Fed is succeeding, they're getting a grip on inflation. Usually towards the end of a recession, we see mortgage rates are dropping. We've seen that at every single recession in the last 50 years. That's the usual pattern. And so what will happen if mortgage rates are dropping? Everybody who is right now in sticker shock because of 7%, and they're moving to the sidelines and they're holding off, they will very quickly and very excitedly restart their plans, and they will jump back in the market and looking to buy a house. So that will make for a very aggressive approach on the buyer side. Sellers will also be more inclined to upgrade because now they can tap into that equity that they have. They have $200,000, $250,000 in equity that they can put down on a new construction home, on a bigger home. And the rates are somewhat more doable, more manageable, and closer to what they're giving up because they're coming out of a 3% or 3.5% rate, and now they're going into a 4 or into a 5% rate. So if that happens, we're going to see more inventory, but we're also going to see a lot more buyers. Remember the demographic shift. A lot of millennials, a lot of downsizers will look into that market, and they will seize that opportunity because rates have come down. And that will most likely be a very competitive market, and very much like this year in spring, then 5% over asking, 10% over asking is becoming a thing again. So that would be the scenario with lower rates. So how can you get around this? One possibility is to use the opportunity right now. The market is softer. You can get a house under contract now. If rates are actually softening in the next year, in the next 2 years, next 3 years, in the next 5 years, you can refinance at that point as long as you're okay and conservative enough that you can afford the house payment with the current mortgage rates. You always have the option to refinance into a lower rate if you believe that is going to happen. And from what every expert is saying, that is actually fairly likely. So with that being said, what are the expectations for the next few weeks, next few months for the Milwaukee area? Milwaukee prices are very likely to remain relatively strong. We're already seeing this, how they're holding up. We're still over 100% sold to list ratio, and I'm expecting this trend to continue. This is what I'm seeing so far in October. And so all the way until Thanksgiving, this is probably what we can expect. Inventory has also probably already reached a peak in August. So against the expectation that the market is softening, inventory is building up, we have already reached a peak and inventory is already in decline. That is seasonally very typical. We see this every time around this year. And so it will go about Thanksgiving, and then the market will contract through the holiday season that usually starts with Thanksgiving and then goes all the way until Christmas and New Year's. And then the interesting thing that happens every year is that come January 1st, people are waking up saying, hey, you know what, it's January 1st, it's the new year. We said we're going to buy a house next year, and then everybody wants to look on Zillow and is looking for houses, and there is very little inventory, and that's usually the starting point for the crazy spring market that we see every year. By the way, if you're more interested in that seasonal pattern, there is, it's a very pronounced thing. I've touched on this a little bit at the middle of this video, but if you want to know the details about it, how you can take advantage of this, and you want to see how this is playing out every year, I have a video that I'm going to put here on the playlist. You can watch this next. It's going to be here on the screen, and that is giving you the details. I think strategy is very important with real estate. A lot of people are taking the approach that they're making a move when they're kind of ready, and one evening they're talking about it, and next morning they call their realtor and they get going with it. But if you are in the position to be strategic and to time the market, take advantage of this information and be as strategic as possible. Also, you can give me a call, send me an email, whatever works best for you, and we'll look at your personal scenario, and then I'll help you map out a strategy and lay out a plan that works best for your personal circumstances. That's all I got for you today. Hope you have a great rest of your week, and I'll see you the next month.